Hey, welcome back to Compounding Quietly. Most investors buy JEPI for the yield alone, and that number is genuinely hard to ignore. But yield alone might be the most distorting reason to own anything. So what should you actually ask first? Let's get into it. A lot of income investors are sitting with the same quiet question right now. Is JEPI the answer to my income problem, or just the easiest thing to buy? The yield looks beautiful from a distance. A monthly check, a steady rhythm, the JP Morgan name on the building. That kind of yield feels safe in a way that very few high-yield products feel. And that is exactly where most investors start to lose their criteria. Because the more attractive a number looks, the less you tend to question what is behind it. You stop seeing the yield as a starting point. You start treating it as the conclusion. This is how most investors first meet JEPI. A friend mentions the dividend over coffee. A thumbnail shows the yield in big numbers. A retirement spreadsheet suddenly looks more achievable, and before any real research begins, the decision feels half-made. Every market cycle, the same pattern repeats with a different fund. A new income product appears. The yield surprises people. The buying starts before the structure is understood. JEPI is not a scam, and it is not a trap, but it is a very specific tool designed for a very specific kind of investor. And if you do not know which one you are, the yield will not protect you. This is the moment to reset your criteria. Before you ask whether JEPI is good or bad, ask what role you want it to play in your life. Is it your core growth engine? Is it the income layer that helps cover your monthly expenses? Is it a defensive piece during a market you no longer fully trust? Each answer points to a very different decision, and the answer cannot come from the yield itself. It has to come from the shape of your portfolio and the cash flow your life actually needs. If that part is not clear yet, the yield is not your problem. Your judgment criteria are. What matters more than how this ETF performs is why the structure exists in the first place. JEPI is not a normal dividend fund. It is a covered call income fund wearing equity clothing. Here is how it actually works inside. About 80% of the fund holds a defensive portfolio of large U.S. companies, drawn mostly from the S&P 500. The managers focus on lower volatility names, not the high-growth stocks at the top of the index. The remaining portion of the fund is invested in something called equity-linked notes. These notes give JEPI exposure to the premiums, collected from selling call options on the S&P 500. That premium becomes the bulk of the monthly distribution you see hitting your account. So when that fat monthly payment arrives, only a small slice of it is real dividends from the underlying companies. The larger slice is option premium income. That distinction matters more than most investors realize. Because option premium is not a dividend in the traditional sense. It is income generated by selling away potential upside. Now picture what this means in a real market. When the S&P 500 explodes higher, JEPI cannot fully follow it. The call options the fund effectively sells cap the upside. This is exactly what happened in 2023 and 2024. Markets ran hard, and JEPI was left behind by a meaningful margin. Investors who bought it expecting an equity-like ride were quietly disappointed. The monthly checks kept arriving, but the share price barely moved while their friends' portfolios were climbing. The picture flips in a very different market. When stocks fall sharply, option premiums rise. The defensive stock sleeve holds up better than the broader index, and the monthly income keeps arriving, regardless of what the chart looks like. This is exactly what happened in 2022. JEPI lost noticeably less than the market, while still paying its monthly distribution. For investors who needed cash flow during that period, that combination felt like a quiet victory. Across the past several years, that pattern has held with surprising consistency. JEPI tends to lag in roaring bull markets and protect in painful corrections. The trailing yield has hovered around 8%, paid monthly. The yield is real. The trade-off is also real. You cannot have one without accepting the other. Coming back to the original question, the real question is not whether JEPI is a good fund. By any reasonable measure, it is a well-built, well-managed product. The real question is whether it fits the role you actually need it to play. If you need maximum long-term growth, JEPI is not built for that job. The capped upside, over many years, can quietly erode the total return you would have earned from the broad index. If you need stable, predictable monthly income, the structure starts to make sense. You give up some upside in exchange for that steady stream. And if you hold it inside a tax-advantaged account, the tax friction from those distributions is largely neutralized. Now think about your own portfolio. Picture an investor in their 50s, drawing closer to retirement, who already has years of equity growth behind them. For that person, redirecting some equity exposure into JEPI can convert volatile capital into a steadier monthly income stream. That is not yield chasing. That is a deliberate redesign of their cash flow before they actually need it. Now picture a younger investor in their 30s, decades away from ever drawing income. For that person, the same fund quietly trades away the single, most valuable thing they own: time and uncapped compounding. Same fund, same yield, two completely different judgments. The product did not change. The criteria did. This is why the same fund creates such different stories in different households. For one investor, JEPI feels like a quiet stabilizer that lets them sleep through volatile months. For another, it feels like a slow leak in their long-term compounding. Both reactions can be correct. The fund did not decide which one you would experience. Your stage of life and your portfolio design did. At this point, the decision becomes simpler than it first appeared. JEPI is not a yield to chase, and it is not a yield to avoid. It is a tool. The only relevant question is whether your portfolio actually needs that tool right now. If your criteria are about income, coverage, and emotional steadiness in retirement, this fund can play a clear role. If your criteria are about long-term capital growth, the same fund can quietly work against you for years. Neither answer is wrong, but only one of them is right for the investor you actually are. That is the real work of investing. Not finding the highest yield in the room, not avoiding the most controversial fund of the year, just knowing what you actually need before the noise starts, shaping your decisions. Investing is not about reacting to a yield that looks too good to ignore. It is about knowing, before you ever click buy, what job each holding is doing inside your portfolio. When that question is clear, JEPI becomes a calm decision. Either way, when it is not, even an 8% yield will not feel like enough. I hope today's conversation helped sharpen those criteria a little. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.